ST Microelectronics designs and develops a broad range of products including semis and electrical devices. On net income margins pretty stable, okay, below the industry average of 18%. Now, ST Microelectronics does again operate in a fairly competitive market, uh, which has decent but not very high, margins. This sector of the market is not known for having really high margins. It operates in a very crowded space. So costs have been increasing at a slowing rate. In the case of cost of revenue, the growth of it, slightly above market, just slightly above market. Has been increasing but slightly above market, but overall it's below the industry average of about 9%, slightly below the industry average. So overall costs have been, they're not growing in line with market. The industry average for R&D is 10% and it's only growing at 6%. Industry average for cost of revenue is about 9% and growing at 8%. So yeah, the costs are increasing but below market, below the industry average. Now the slow rate of cost is due to a large degree to margin as well as profit protection. It makes sense since the market is heavily competitive. Spending is to be wise and methodical. R&D as a percentage of revenue is below the industry average of about 20%. Again, makes 100% sense. Low margin industry is not really gonna go all out in R&D. Not that you don't want to, but because it doesn't make sense to say you're operating a very low margin industry. But the good news is that the R&D as a percentage of revenue has been stable. Revenue growth is below the industry average. Industry average is about 8%. Now you can argue, which I am right now, that these costs are providing some form of return. I mean, it's below industry average, but even though not spending that much, it is providing some form of return and is resulting in very stable margins. So yeah, there is some form of return, even though it's small. The same can be said with the net income. There is a return. It is small, but there is a return. The return on equity has been declining, which is not a good sign. Overall, however, West Electronics is very profitable. The financials indicate that it's a very well-run company, but does operate in a very competitive market. Adding COVID into that just makes this a meh company. I mean, I'm neutral to it. These financials, I'm pretty neutral to it. Current ratio is above industry average. Industry average is about 2.37. So it has outperformed industry average. Good. Strong indicator of liquidity. A solid sign that the balance sheet has limited liquidity risk, even though there has been some decline. But again, over this 2020, so you might have had to spend much cash on hand, to protect the industry from the effects of, to protect, the company from the effects of COVID. The asset test ratio above the industry average. Industry average is about 1.88. Same with the current ratio. Good performance, doesn't indicate heightened liquidity risk. Yeah, it's good overall. You know. Now both these ratios, the asset test and the current ratio, their overperformance that makes the balance sheet very attractive. From a liquidity point of view, very limited liquidity risk. This is driven by the over $3 billion in cash and cash equivalents that microelectronics hold on its balance sheet. Inventory days are slightly above the industry average. The industry average is just over 101 days. It's at 100, just over 102, so slightly above. However, this does not indicate the heightened inventory risk in my view. Overall, still good good inventory management. Considering 2020 was a tough year for these semi manufacturers, considering I don't think they had to hold on to quite a lot more stock that they would have loved to, even stock that was manufactured for quite a long time to ship it because of supply chain disruptions. But overall, yeah, I mean, good liquidity, very, very good liquidity. So the risk caused by liquidity is very low on estimate microelectronics balance sheet. Now the debt to equity ratio far below industry average. Industry average is 126, so it's below industry average, so it makes the balance sheet less risky. So overall, from a liquidity point of view, not risky. From a financial risk point of view, very low risk. It's a liquid, very attractive balance sheet. The cash position. The cash margin is below the industry average. Okay, not good. Not expected given the high levels of competition. But still does indicate that even though it's low, it does still indicate that the business model can generate cash from operations. The sufficiency of cash flow is above the industry average. Industry average. Industry average is about 1.34, so a very good indicator. Also highlights the strong um, cash flow position ST Microelectronics is in. Reward shareholders at a pretty fair-ish rate. PE, however, for me, you know, not that high considering the industry average is about 40 and it's trading at a PE of almost 36, so below the industry average. However, microelectronics for me, I don't know, it's a bit of a meh company, I mean, not too good, not too bad, just in the middle, but there are companies in the sector that can give you better returns in my view.